Okay, the opening day balance sheet, similar to the balance sheet projected, this is the balance sheet of all of your assets and liabilities on the day that you open the doors for business, or the day that you list as the date of inception for your business. You can see the categories here. Again, as with most things here, they're fairly straightforward. Cash in the bank, exactly. What's the balance of your bank account on the day that you open? How much? What is the value, the dollar value of the inventory? Not how many pieces you have, the dollar value. Do you have any expenses that you've already paid? That's considered an asset. That's prepaid assets, and you may need to. There's a line for other, but you may need to include other lines as well. Those are current assets. Those are things that can be quickly liquidated and turned into cash. That's what a current asset is. Something that is short term in nature. Fixed assets are more difficult to turn into cash, more lengthy to longer amount of time to sell them. Generally, there's some discount involved in selling them as well, and so those are fixed assets. They're more long term in nature. The goal there is not to be buying and selling these assets. Not a lot of turnover in these types of assets, and that makes sense when you look at the makeup of the fixed asset category. You've got furniture and fixtures, things that stay in place for a while. Machinery, real estate, buildings, those kind of things. They don't turn over very often. You may have other assets that may not necessarily fall into either of those categories, and you want to categorize them there. That's fine. Liabilities, current liabilities, similarly, those are some that are short term in nature, generally due within the next 12 months. Taxes, accounts payable. Accounts payable is money that you owe to vendors or suppliers for product or service that you have received from them. So that is an amount that is payable to them, called accounts payable. Taxes payable, that's taxes you haven't yet paid, but you may have incurred, or you know that you're going to incur in the months ahead. Notes payable, a loan, any amount that's due within the next 12 months. Um, uh, and then long-term liabilities are those that are generally greater than 12 months in length, such as long-term loans, um, or notes payable to stockholder. Maybe a stockholder has an equity position, but they also loaned money to the company. You as the startup venture organizer may have loaned money to the company and want to be repaid, and so that would be listed here in the long-term liabilities. And then, of course, assets minus liabilities equals the owner's equity or the net worth. And so this is just a little quick snapshot. Again, the balance sheet is nothing more than a snapshot at a given point in time, and you would need to define what that time is, what the date of the snapshot is. And so it's fairly straightforward. But again, don't just fill it with nice round numbers and whole numbers, thousands and 5,000s and whatnot. It needs to flow from other areas, from your plan as a whole, and need to have put some thought and time into it. Okay, we'll end this video now.